Hello. So far we've talked about concrete assets, commodities, and shares which represent a part of a company, all relatively solid. Now it's time to look at an asset that doesn't actually exist, the index. An index is a listing. The index at the end of a book will include keywords and where to find them. In mathematics and economics, an index is a statistical measurement of a group of data points. And in finance, it's a measurement of market data. Economic indexes include producer, wholesaler, and consumer price indexes, consumption, sentiment, and confidence indexes, purchasing managers indexes, housing indexes, and many more. Some of these are a result of quantitative measurements. Others are based on polls. Stock indexes measure the performance of a specified stock exchange. These indexes take a selection of different stocks and group them together to measure the performance of the market. They're a tool used by investors and traders to describe the stock market and compare between different sectors. When investors refer to the performance of the market, they're referring to the performance of a stock index. The history of indexes begins in 1860, when Henry Varnum Poor of the famed S&P, that's Standards & Poor's, published a listing of companies laying railroad tracks throughout the United States. Soon after, Charles Dow, a founder of the Wall Street Journal, published the first stock market index. Dow measured the average of the top 12 stocks being traded on the New York Stock Exchange. Soon, Standards & Poor began publishing a regular index covering 223 stocks. Standards & Poor then had to reduce that to 90 stocks. Then in 1940, they purchased a computer and increased their coverage to 500 company shares. That's the S&P 500, and it's updated every hour. Today, nearly every stock exchange publishes an index using various forms of weighted averages. These indexes provide a benchmark for comparing the performance of shares, and some publish sectorial subindexes as well. And since a stock index is a mathematical construct, it cannot be invested in. One cannot own a stock index. Instead, we can invest in index-based exchange-traded funds, or ETFs, which track the performance of the index. We can also invest in other derivatives like options and contracts. These instruments are based on the underlying price of the index, and they'll move in line with them. The first ever ETF to track an index covered the S&P 500. Now there are literally hundreds of ETFs and futures contracts which track different groups of stock. Stock market indexes may be categorized in many different ways. A world or global stock index is made up of companies irrespective of where they're based or traded. A national index represents the performance of the stock market in a given nation. It's a good gauge of investor sentiment on the state of that country's economy. The most regularly traded national indexes include the U.S.'s S&P 500, the Japanese Nikkei 225, and the UK's FTSE 100. Stock indexes can also represent the performance of companies of more extensive geographic regions. The Euro Stoxx 50 covers 50 blue-chip companies based throughout the Eurozone. The MSCI Emerging Markets Index is made up of stocks from emerging economies such as Brazil, Mexico, and South Africa. Finally, there are unique indexes that relate to certain industrial sectors. The NASDAQ 100, for example, consists mainly of companies in the technology industry. So, in short, there are hundreds of different types of indexes, and they all measure the performance of stocks in different sectors and areas. Now, it's important to understand how these indexes are computed. Mostly, they aren't simple averages. Each stock in an index is usually given a level of weight or importance. Otherwise, we'd have an equal weighted index, but those are rare. Most indexes are weighted either by price or capitalization. A price-weighted index weighs each stock by its price. A share trading at $100 influences the index 5 times more than a share trading at $20. Examples include the Dow Jones 30 and the Nikkei 225. Unfortunately, this doesn't take into account a company's size or market value. Now, the capitalization method takes into account the total market value of a company's shares. It multiplies share price by the total amount of shares a company has ever issued. And so, if our first company has 100,000 outstanding shares worth $100 each, then its market capitalization equals $10 million. Our second company, with a share value of $20, has 1 million outstanding shares. Its market cap will be $20 million, double. The S&P 500, FTSE 100, CAC 40, and DAX 30 are all capitalization-weighted indexes. Next topic, ticks and ETFs.